Good morning, everyone. This is Rodrigo Santano with Top Trader Academy. We recently had our May meeting and we covered a topic that's very important, I think. So I decided to record it and put it on the channel so that everybody can benefit from it. We're talking about adjusting strangles. Let's go into the meeting and see what it covers. As always, toptraderacademy.com is our website, and underneath here you can see my email address, rodrigo_santano at toptraderacademy.com. Our meeting, the AAFT meeting that we have every month, you can look us up on meetup.com, and it's the second Thursday of every month at 6:30 p.m. Central Time. So again, you can look up AAFT, Austin Association of Financial Traders, in meetup.com. As a disclaimer, we're not financial advisors. This is for educational purposes only, so trade at your own risk. And all material here is copyrighted under US and international law. So let's start with what's a strangle. A short strangle consists of one short call with a higher strike price and one short put with a lower strike price. Both options have the same underlying stock and the same expiration date, but they have different strike prices as we mentioned above. Potential loss is unlimited if the stock price rises and substantial if the stock price falls. And this is what it looks like. The reason we like to sell options is because we have theta on our side. As you can see from this P&L graph here, your profit zone, which is this green area here, you make a profit as long as things progress in time, and you start with zero profit, and if the stock, let's say, expires between your call strike and your put strike, you make a profit. So what that does is it gives you a much wider probability of profit than if you were simply just buying stock or selling stock, because that is a 50-50 shot. This has a much higher probability of profit. And you will hear some people talk about 30 delta strangle, 16 delta strangle. That when you open an option chain in your platform, you will see deltas in the calls and in the puts. If you see a 16 delta strangle, it'll be wider, so have a larger profit zone per se, than a 30 delta strangle, but the trade-off is your profit potential is smaller for a 16 delta strangle versus a 30 delta strangle. So it's all symmetrical. The tighter you go with your strikes, the more potential profit you have, but the probability that the stock is going to land inside that zone is lower, right? We can go into iron condors, we can go into what a cover call is, but for now let's just stick with strangles because that's the topic for today. Now the natural progression of an option trader, just so you understand, is first there's people that only buy stock, and that's number one here. So people that have stock and add a short call create what's considered a cover call. It is still a bullish position, but you are reducing your cost every time you sell a call. So it's in essence similar to having a dividend pay every month, right? So it's also similar to owning a house and renting it every month. What you do with that is you start lowering the cost of the house until your house is paid for. Then people start figuring out that a short put is exactly the same as a cover call, except it has better capital efficiency. It's still a bullish strategy because you want the stock to go higher, but a short put, again, in essence, is the same as a cover call. As time progresses, the option trader will figure out that he no longer wants to be bullish, that he or she would much rather be neutral, and they start selling a short put and a short call verticals, and that creates an iron condor or an iron butterfly. right? So you're getting into neutral territory, which is what we do. Eventually you figure out that the vertical itself takes away from your profit capabilities. It makes your profit smaller because you're buying options too. So you end up with what we just started, the short put and the short call, which is a strangle. And that's better capital efficiency than the iron condor. And it's also neutral. So again, the strangle is what we're going to discuss today, which is simply a short call and a short put. So we know selling options is profitable, but how do you manage their undefined risk nature in the case of a strangle, right? What do you do when things go wrong? And that's why I decided to record this, because it's very important to stay out of trouble. And to be profitable, you need to know how to adjust the strangle, or at least the basics of it. Why we do it, how we do it. Selling options is what is profitable in the long run. Buying options can be profitable in the short run if you catch a good wave of increasing volatility. But in the long run, selling options, it's what's profitable. You can equate that to selling insurance. You know, if you're selling insurance, it's like selling options. I know you all buy insurance for probably your car or your house. And if you add all of the payments you've made to your insurance company, it's probably much higher than whatever the insurance company has paid you in the past. And that's what we're talking about. You want to sell the insurance, you don't want to buy the insurance. Now, of course, if you are maybe 16 years old and you get in a car crash and you've only made 2 payments in your lifetime, then in that case you would say, okay, buying insurance is better than selling insurance because they just paid me for a new car and I had only paid 2 payments, right? And that's the case of when buying insurance in the short run on a lucky strike could pay you more than you've paid. But in the long run, as we become adults, we add up all of our payments and we figure out that selling insurance is where it's at, and who makes the most money is whoever sells the insurance. So we're gonna do 2 simulations. Of course, in a strangle situation, the ideal case is that the stock stays in between your strikes and you don't have to do anything, right? But that is hardly ever the case. And we're gonna do 2 simulations. The first one is gonna be if the market starts going towards your put side, to the downside, you know, in a sustained manner and pretty fast. We're gonna sell a 1 standard deviation strangle, which is the 16 delta strangle. It's gonna have a sustained drop of 2.5 points per day, volatility increase of 0.5 points per day, and we will reestablish the trade when the strike is breached. When the put is touched, that's when we'll reestablish the trade. Now, why volatility increases, and everybody should know this, when the market drops, volatility increases. Volatility is a measure of fear. So as you might think, when the market drops is when fear becomes exacerbated, and that's why volatility increases when the market drops. Conversely, when the market goes higher, volatility will decrease, right? But in this case, we're just saying we started with a delta neutral strangle. We saw the 16 delta strangle, and the market is every day dropping and volatility is every day increasing. Now, the management of the position is we will maintain around negative 10% of the theta in short delta by buying or selling SPY shares. Now, this gets a little complicated, but you just have to know that delta is our directional risk, and theta, like I mentioned in the opening of the video, is your time decay. So if you're selling options, you'll have positive theta, and we want to maintain a little bit of that, a little bit of short delta to compensate for the volatility increase. And we will see all that in the simulation here. So this is day 0. This is how our position looks in the beginning. As you can see, this purple line is just very centered, right? We have a little bit of short delta, which means the center of the purple curve is a little bit to the left of where we are right now, but it's very little, right? So we have a theta of 13.66, which what that means is that this curve gains $13.66 every day that goes by, to the point where that purple line becomes this light green line here, right? So that's how much we're making every day. And the delta is the negative 1.12, which we said was negative 10% of our theta. And that little negative delta is what gives us a little bit of the skew to the right of the center of the curve. Right, so this is day 0. You open the Strangle. You open that yourself, of course, with the 16 deltas. And time starts, ticking away. So on day 1, the market is down 2.5 points. Like we said, volatility is up 0.5 points. Now notice how the curve, the purple curve, went down a little bit. And that is the effect of volatility going higher. When volatility goes higher, options get more expensive, and we're trying to sell something expensive and buy it back cheaper. Now, to counteract the drop in the market, we sell 5 shares of SPY to maintain closest to the desired short delta. So it's very simple. The theta is 14.42, and we want to maintain the delta of negative 10% of that. So by selling the 5 shares, we are able to maintain a negative 1.62, which is roughly negative 10% of the theta. What that does is it starts, you can see how this Strangle is starting to lean towards the right a little bit, right? And that's what selling those 5 shares does. It keeps our curve centered, the purple curve centered, and a little bit to the right because we have a little bit of negative delta. Day 2 comes and the market is down another 2.5 points. Volatility is up another 0.5 more points, and we sell 4 more shares. And you can start seeing a trend here. I'm starting to sell shares to maintain this purple line, this purple curve centered and a little bit to the right. And our Strangle is leaning a little bit more to the right because we sold another 4 shares. Day 3 goes by and same thing happens, right? So market down, volatility up 0.55 points, and I sell 4 extra SPY shares. Again, my goal is to keep this purple line centered and a little bit to the right because of the negative delta, right? You can always see in these slides I have theta positive and delta a little bit negative to make it negative, as close to negative 10% of theta. Right, that's our model, and that's why we are doing how we're doing it, right? So day 4 goes by, same thing. Day 5, same thing. Notice how as the days go by, this curve keeps sinking down a little bit because of the increased volatility. And as day goes by, day 7, day 8, day 9, day 10, day 11, day 12. Okay, on day 12, we have been maintaining our delta at negative 10% of theta, right? So we sell the last 3 shares of SPY, and our strike is basically breached, which means we reached this top here. We saw the 380 strike put, and we are right practically there, right? So it is important to note a few things here, right? So we've been working this trade by selling shares of SPY to maintain our delta to theta ratio, and right now we're at a negative $180.16. Now this is worse or bad case scenario 1, right? This is not how all the Strangles work out, but this is how it could work out, and it is very important that you know how to defend something when it's not going right, because making money is very easy, but defending something is where you gotta be really good at, because this is it's not a matter of if it's gonna happen, when it happens. This is gonna happen eventually, right? So your negative $180, You've been selling shares to keep your curve centered. Remember, delta is your directional risk, so you've been keeping it very centered with a little bit of negative twist. Now, what would have happened if on those 12 days I hadn't done anything? If I just let things go down, right? The market go down and I don't do absolutely anything, you would be negative $874 on your trade, right? Notice how this, in this case, my strangle is not leaning towards the left or the right or anything. I just sat down and watched days go by and I didn't adjust anything, right? Notice how your delta now is very big, 45.94 when you compare it to theta, which tells you that you haven't been adjusting and you did not adjust on that day. So here is the two differences, right? If you had adjusted, you would only be down $180. And when time goes by, you will make that money because this purple curve is gonna go up to the light blue curve, right? In the other case, you're $874 down, and you don't want to be in that position, right? This is why I'm telling you, you should adjust and you should keep some amount of negative delta, right? So let's go into simulation number 2, which is breach to the upside. Is the opposite. Your strangle ideally stays, the underlying stays inside your call and put, but in this case, we have the other bad case scenario, which is when the market keeps going higher and consistently going higher towards your call strike. So what do? We're gonna start with, again, the same position, 1 standard deviation, so the 16 delta strangle, sustained raise of 2.5 points every day, but now volatility is gonna decrease 0.5 points per day. Remember, when the market goes higher, volatility decreases. When the market goes lower, volatility increases. And again, we will go up to the point to when the strike is breached. In this case, the call strike. We will maintain around the same negative 10% of theta in short delta by buying or selling SPY shares, same as in scenario 1, since we don't know the future, right? So notice we're not keeping positive delta. We're doing exactly the same thing. We're maintaining negative delta, but we're controlling it. We're keeping it at negative 10% of theta. So again, day 0 starts at the exact same point where the other scenario started. You have again a negative 10% in delta of your theta, and things starts moving, right? So day 1, the market is up and volatility is down. Now in this scenario, as you might see, the purple curve is starting to go higher, and that is because volatility is going lower every day. Now again, to maintain my short delta, in this case I have to buy 5 shares. So you're going with the market basically. If SPY is going higher, and this is called delta hedging, you're buying shares. In the previous scenario, when the market was dropping, you're selling short shares. And we just do as many shares as it takes to keep this ratio close to negative 10% of your theta. So theta is 12.91. We're trying to keep it at negative 10%. So by buying 5 shares, I maintain and I'm closest to what I can do, which is negative 0.64. Day 2 goes by and I buy 4 more shares. Now in this case, look at the strangle. The strangle is starting to lean towards the left. And we're still maintaining a centered curve, the P&L curve on the purple line, but always a little bit to the right, which means we have negative delta. But also notice that keeping negative delta doesn't mean that I'm gonna be short SPY shares, because I'm buying SPY shares. And this helps our position, even in this scenario. Day 3 goes by and the same thing happens, right? We get 2.5 more points to the upside on the market, volatility down 0.5 more points, and so on and so forth. And I keep buying SPY shares, right? And days go by, and on day 8, my strike is breached, so I would reestablish the position. But notice my P&L, it's $255.81. So I made money by keeping short delta, which is it's gonna bend your mind a little bit, because you're gonna say you were short in your position and you still made money. But that's because I had to buy shares to keep my desired short delta amount. I don't want an indefinite amount of short delta. I just said I wanted negative 10% of my theta in short delta. So again, I'm $255 up. And the reason is volatility has been shrinking and this purple curve has been going higher. So at this point, I will just close my position and re-establish a new position and start all over again. Now, what would have happened if I hadn't been adjusting? This would have happened. I would have lost the opportunity to make money because I wasn't adjusting, and I would be at negative $118.70. Right? I did not keep my curve centered. I have a large amount of delta, negative 49.29 on $7 of theta. So this is a dramatic difference between having adjusted or not. Again, keeping a little amount of short delta means even buying shares when the market is going higher and selling shares where the market is going lower. Right? Don't be fooled by thinking that people that keep short delta, a little bit of short delta, are going to lose money when the market goes higher. That is not the intent. The intent is to have a little bit of short delta to compensate for the volatility increase if the market goes down, like we saw in the previous scenario. We were way off doing the adjustments either to the downside or to the upside. In both scenarios, it worked. Now, these are bad scenarios. Ideally, the market didn't move much and you just ride the curve up and you do very little adjustments. So again, if you adjusted, you made $255.81. If you did not do anything, you lost $118.70. And this is why I wanted to publish this video, because it's critical that a lot of people get misled by trying to sell options, but they're not given this little bit of information. And there's a lot more information that I could give to you, but we don't have time in such a short video. But this is what you should come out with. This is how you adjust, or why you adjust a strangle. Right? So the takeaways, the two worst cases for a strangle is an extended up or down move in the underlying, and we simulated those two scenarios. Managing the deltas in the trade will vastly improve your outcome in extended move scenarios, which is what we had in those scenarios. Right? The thing kept going against us day after day after day after day. By keeping some amount of defined short delta, it will never be perfect, of course, we can vastly improve the outcome of an unmanaged strangle, both to the upside and the downside. You saw how even if we're keeping short delta, we make money to the upside. We use short delta to hedge Vega. Vega is the volatility expansion. That's why we don't stay perfectly delta neutral, which would mean we don't keep any negative short delta. We just keep centering it to zero delta every day. Volatility expands to the downside, and that's why we keep a little bit of short delta. Right? It's never going to be perfect. Some people like to keep some amount of delta, short delta, some amount of other people like to keep more short delta. It would be like reading the future if you knew exactly how much volatility was going to increase when the market drops, but you know it's going to increase most of the time. And this is just a real data on how a strategy like this does, right? The red one is the one we just did. The other one is adjusting with options. There is another school of thought that you want to adjust the untested side. If the market goes higher, for example, you start to pull in your put leg closer to the call leg, and you roll the untested side. Now, while that works, it makes your trades very narrow, right? You can end up inverted, you can end up with a straddle. I much rather prefer to do it with stock, because that keeps the probability of your trade as it was in the beginning, right? It uses more capital, but I much rather prefer it because a lot of times these things can backlash at you, and the market will be going higher, then it'll be going back lower. And if you've been adjusting your other leg of your option, then the green line happens, right? And you're not as profitable and not as consistently profitable because you're narrowing and tightening your strangle. You can end up, like I said, in a straddle, or you can end up inverted. So if capital allows, I much rather adjust with stock. And you can do sometimes one, sometimes the other, depending on your capital, right? So we can teach you all that. That's not a problem. Again, we have tools to help you navigate this and keep the small amount of short delta that you need. That's not a problem. We have the same tools that tells you how many contracts to do. I cannot tell you how many people fail in this business because they over leverage their accounts, right? You need a tool or direction on how many contracts you need to do of what, so that you stay out of trouble and you don't over leverage the account. So we have tools for all of that. We can use portfolio margin accounts, we can use margin accounts, but still the broker is going to give you a lot of leverage, and leverage works both ways. It can help you or it can hinder you a lot. And if you abuse it and you don't keep your deltas tight and you do too many contracts, you will get in trouble and you might blow up your account unnecessarily. And that's why we do this free class every month. Again, look us up on meetup.com under AAFT, and I try to put videos that help almost anybody as much as possible, but there's different levels of education of the people that come up to the meeting, so it's difficult to help everyone, right? This might be very basic for some people, or this might be very complicated for others, right? So that's why we offer courses to help you bridge that gap and get to where you want to be. We also have tools to tell you it's time to either move your call to the 15 delta or sell 42 shares, right? So this is the case where the market is going lower, right? We learned that you would be selling shares if the market's going lower, or you pull your call strike down. We didn't go through that scenario, but that's the green curve that I showed you. I'd rather sell the shares, especially if you have a portfolio margin account, but even in a margin account you can do it, and just keep an eye on your capital usage. You can always move your call delta and undo the shares if you need to, so that's no big deal. Tools like this are live, connected to TD Ameritrade in the background, so all these numbers are live and working for you throughout the day. It gives you an audible alert. You can turn it off if you don't want to hear it, but you can leave it on so that you can be doing something else and you just hear an alert and you go and adjust. So a lot of these tools will help you a lot. Again, this is the website if you guys want more information. If you put in your email address, you'll get free information and a dip discount offer via email. You will also get informational emails and videos on what are options, how to trade options. So I think it's well worth your time to invest a little time in learning options. These are some of the topics that the complete course covers. You have 30-day WhatsApp support included. I post my trades live while the market is open to the students, so they can ask me, why did you do this? Why didn't you do that? You can ask me one-on-one via WhatsApp. We use WhatsApp because you can take a screenshot of your phone or your computer. You can use WhatsApp web on your computer, and that's what I use to show you exactly what I'm doing. So I try to help everybody. This is a complicated topic, right? So there's Greeks, delta, gamma, theta, vega. So what this course does, it puts everybody at the same level so that you understand. Once you get into what's called the bootcamp, which is included with the course, you are at the same level as everyone else and you understand what we're talking about, right? So it starts from very introductory material to very detailed material like the one we're discussing today. Again, it's more than 6 hours of online videos. You take it at your own pace, and then eventually you get to the boot camp, which is the 30 days included, and you start trading live with a paper account. I can help you set up a paper account with TD Ameritrade, and that's what I like to do for students because, you know, it's you don't want to do it with real money until you understand the platform and the strategies, right? And what's at risk and how your P&L is going to move from day to day. So that is pretty much all I have for you guys today. Remember to join us, meetup.com, AAFT, which is the Austin Association of Financial Traders. I'm part of both organizations. One is a free organization to help people out. The other one is paid, but it's not expensive if you're planning on trading options. Trust me, one wrong move is way more than this course could be worth to you. So let me know if you have any questions. There's my email address at the bottom here. There's the website, toptraderacademy.com, if you want more information on options and some discounts. And just wish everybody good luck with your trading, and let me know. Thank you very much. Bye.